everything so far has been not as bad as feared. Are you fearful? Are you afraid? Are you conservative? It's okay. We don't have to say fearful. You could just say conservative. You'd rather err on the side of caution. And because you don't want to be wrong, you don't want to put out any kind of prognostications where you could be shown to be wrong. But if things get good, you're late to the game. And today, the CPI came out and it was relatively good. So less bad news, not as bad as feared.
Get ready for a new episode of KP Talks Dollars and Cents. Learn financial literacy and get real-time updates on all things housing, finance, and real estate. So let's get started. Here's your host, Kevin Perenio.
Hey, it's KP coming to you live from Corona, California. Well, I did one take, 10-minute video, and I listened to it, and the audio sucked. So hopefully this is working again. Take 2, 1 a.m. after midnight on a Monday. We had our senior management meeting today, the first Monday of every month. And we're game planning, talking about things we're doing for the rest of the year, new products releasing, close-ended second, all kinds of stuff. I think I even teased up a product last week, the Borrower Smart product that we're rolling out with Freddie Mac. I thought that was pretty cool when I was talking about Freddie. And our Chief Marketing Officer, Paul Lucido, brought up a cool point. I think we're like 34, 36 pints of blood donated just from the corporate team here in Corona. Not a humongous office, but up to 55 lives can be saved with that blood we've donated. So I thought that was pretty cool. So wanted to share that. Thank you for the PRMG Cares team and Paul Lucido, Annie Chow, and everybody that works at behind the scenes. Okay, jobs report came out last Friday, and it softened interest rates. It made the 10-year yield come down. Why? 187,000 jobs created. That's good, right? Well, not completely. The estimate was for 200,000. It's 13,000 less, my lucky number, 13. And then the prior month number was 49,000 jobs revised lower. So that's softening, less good news, less growth, which is typically bond-friendly and mortgage interest rate friendly, because that means we're closer to this recession that has been talked about for 2 years, that has not come, has not started. The JP Morgan Chase even said last week, they said it, they are taking recession off the table for 2023. And we know that we've been following, and I've been talking about Goldman Sachs. Their estimate for a recession to even hit at all was at 30%. And they revised it down a couple months ago to 25%. Now they're down to 20%. So if this thing comes, or whenever it's going to come from the labor market breaking. And there was some softening with that jobs report. The July Bureau of Labor Statistics jobs report. There was less jobs created, less than expected, and less than the month before. So next month, when we have the August jobs report on the first Friday of September, are they going to revise that report lower? And will that one also be lower? I don't know. But the trend has been set in. We've got 2 jobs reports in a row under 200,000. So that is softening, and that is bond-friendly. 10-year Treasury yield, the 10-year bond, the 10-year note, remember bills, notes, and bonds. The 10-year Treasury yield was going up last week. Remember Japan, the yen, they were doing some yield curve control, buying their own Japanese yen, but they typically have to sell US Treasuries to raise money to then buy their own yen and control their yield and cap it at 60 basis points. That actually then flooded the market out there with more US Treasuries, which means there's more supply of money out there, which means any investors that are out there will demand a higher yield, which then makes mortgage interest rates go up generally because they're all kind of tied together, all this money thing. Remember the bond vigilantes that are out there? You know, if they decide, hey, we're not going to have you, U.S. government or whatever government, shove all these treasuries down our throat and force us to buy it, the bond vigilantes can say, hey, we're not buying it. It happened. It goes by both. They are like apolitical. It's happened in a couple of different parties. I'll give you an example. So George Soros shorted the British pound in this record $1 billion trade he made and crushed their currency like 92. Clinton in 94 tried to pass a huge bill and spend all this money. And the bond vigilantes said, absolutely not. We cannot, buy all these treasuries. And so he had to reduce down That spending bill happened to President Obama in '09. He tried to have a huge stimulus bill and had to bring it back and pare it down because the bond vigilantes said, we are absolutely not going to buy this much debt. You need to control your spending. And it just happened to the Conservative Party in the UK. The shortest term of a prime minister ever, when she tried to raise spending and cut taxes at the same time. Bond vigilantes over there said, we don't care whether you're conservative or not, we're not paying for it. So we will see what the bond vigilantes do. We've got lots of spending, lots of entitlement programs, lots of defense spending, tons of debt being issued. We have $33 trillion in debt out there. It's constantly being refinanced. Like I said, I read some pretty cool articles. At the end of the Chrisman blog today, there's a mention that the U.S. government is constantly selling and auctioning off debt. Every 3 months, there is a sale of longer dated securities. This week's market moving events include the $103 billion quarterly refunding between Tuesday and Thursday. So we'll see how that goes this week. There are 3-year notes being auctioned off tomorrow, or later this morning in like a couple hours. And there's 10-year notes being auctioned off. So all this supply of money coming on. What is going to happen with all the institutions that have to pay for this money? Bill Ackman made a bet last week. If you don't know who he is a legendary trader. He's had several big calls, big short type calls, making billions of dollars on trades. He basically said, this is very interesting. Try and break it down. I have all the details in front of me, but he basically said that he thinks inflation will stay materially higher for longer than we think. Let's say 3%, not the 2% target. So if we're at 3% on inflation for materially longer, and the government hasn't really been using the 30-year long bond in part of this refunding of our government. I mean, it's still relatively cheap for a 30-year Treasury. And so he thinks that the belly of the curve, the duration of the curve, we're going to have to kind of take all this debt that's coming on and kind of extend it out a little bit longer than the Fed is currently thinking. He thinks it's actually, Bill Ackman actually says the Fed is mismanaging the duration. He thinks he could be using that, and that they will, and they will be forced to, because inflation will stay around 3%. Long-term inflation is generally around 2.7%. So him saying at 3%, considering what we've been through with all this huge money supply and this kind of slower growth, although the economy is still growing, 2.4% in the last GDP reading, he's saying if you're at 3% inflation, add another 0.5% to get to the real rate, then maybe 2% in premium, you're at 5.5%. So instead of selling short the US Treasury, what he did, which also works as a hedge, I'm not a financial advisor, I'm not responsible for your losses, only your profits, it's not advice, but he's buying puts, okay? So if you pay for a coupon that bets that the Treasury price will go down and the yield will go up to that 5.5%, that's a hedge against stocks doing bad if that happens. And so if he's wrong, he only loses the price he paid for the puts. Then his stock prices go up. So it's both a hedge and a pretty good standalone bet. Pretty interesting. He did mention Japanese yield curve control, which we saw them do that, which was forcing them selling U.S. Treasuries to get their yield curve control at 60 basis points. Selling U.S. Treasuries, flooding that market, caused our 10-year yield to go up, and then the jobs report came down, and we softened back out. So we touched around 4.2 and then came back down on the 10-year yield. Don't forget, I talked last week about the BRICS Plus, Brazil, Russia, India, China, South Africa, and now August 22nd, they're going to admit Saudi Arabia. It's like 54% of the world's purchasing power trying to de-dollarize the world. So there's all these forces kind of circling right now. We have to keep an eye on it. And Bill Ackman, just to put a bow on it, he said the 30-year Treasury can reprice in a matter of weeks. So he's betting on it. We'll see. CPI out Thursday. So is the PPI, the cost of producer price inputs. So it's a producer price index, but it's the cost of inputs to make goods, which we know goods are down. Manufacturing is down. The ISM manufacturing is below 50, which means contractionary, like recessionary. Above 50 on an ISM reading is expansion. ISM services, the price for services has been up. Going to dinner, paying for services, all those kinds of things. Leisure hospitality, we know has been elevated. That's where a lot of the inflation is right now. especially non-housing related services. ISM services data has been, well, reading last week was 52.7. Still above 50, but less than 53 where it's been. So it's slower growth. So the CPI number coming out Thursday is humongous. The base effect, which I talk about all the time, last July's 22 number, base being replaced with a new base. Interesting enough, Barry Habib pointed out that July 22's base was a negative number. So if it's replaced with 0.2, replacing a negative 0.1, we could go up 0.3%, a 3.3%, going from 3 to 3.3%. Will that headline number give the Fed more juice on September 20th to raise yet again? We'll see. Huge week. Cheers. Hey, it's KP coming to you live from Newport Beach. We are literally on the beach. It is 12:15. It's after midnight on Thursday night. So it's technically Friday morning. And it's been a hell of a week. But my phrase for the week is not as bad as feared. Everything so far has been not as bad as feared. Are you fearful? Are you afraid? Are you conservative? It's okay. We don't have to say fearful. You could just say conservative. You'd rather err on the side of caution. And because you don't want to be wrong, you don't want to put out any kind of prognostications where you could be shown to be wrong. But if things get good, you're late to the game. And today, the CPI came out, and it was relatively good. So less bad news, not as bad as feared. So I turned 47 on Sunday, August 13th, Leo, and my kids go to school in 2 more Mondays. So we got 10 days here on the beach. We're going to hang out. We're going to end the summer on the beach. So feel very blessed for that. CPI was 0.2% for both core and the headline number. And this is probably the second most watched inflation figure. Remember, we're fighting inflation, and the Fed is raising rates to bring inflation down. Inflation comes down, mortgage interest rates come down. So the CME tool showed the Fed funds future at 89% chance that the Fed will not raise again September 20th on their next meeting. Hopefully my audio is okay. I got these new little earbuds. I try to take on some fancy earbuds. They're only $199, but hopefully my audio is okay. We'll see. But not as bad as feared. So if the Fed's done raising, the average time from the last Fed rate hike to the first rate cut is 4 months. Now, we have a lot of money in the system. We've never had this much liquidity pumped into our system, for 0% real rates, negative real rates. The Fed actions during COVID never had this much liquidity and money supply built. So when they say higher for longer, they're probably going to have to deleverage for a little bit. Maybe they go another 25 basis points. I don't know. I'm seeing a lot of mixed feelings. But inflation is not as bad as feared. What else is not as bad as feared? I'm going to get back to inflation in a second, but I want to talk about Fannie Mae. I talked about Freddie Mac a week ago, and I want to talk about Fannie Mae. It's only fair. We love our partnership with the GSEs. At PRMG, we service with all 3 GSEs. Now, what's interesting about Fannie Mae is they reported $5 billion in net earnings in 3 months. So in 3 months, they made $5 billion. Now, we're just a tiny little independent mortgage banker and just trying to survive and make it through this crazy time. And we love our partnership with the GSEs. $5 billion. Now, part of that $5 billion was, and look, they got a reserve for losses. They're backstopping housing. I mean, I guess, in theory, it could go in a heartbeat if this was 2008, but it's not 2008. And you know what? They even acknowledged it because part of the $5 billion in net profit was $1.2 billion in loan loss reserve being reversed. So that means not less than feared, not as bad as feared. So they were reserving conservatively, as were all institutions. Fannie, Freddie. Freddie's big multi-billion-dollar net profit had something to do with them reversing their loan loss reserve. A lot of the financial institutions are reversing their loan loss reserves as well. And so when you see that happening, it's an acknowledgement that not as bad as feared. Now, that doesn't mean there won't be losses. That doesn't mean they don't have tons of capital expecting job losses. We saw the jobless claims go up today. We've seen a softening of job growth with the monthly BLS reports. So there still is going to be some defaults. Typically, defaults match mortgage defaults, people that cannot make their payment, typically matches almost exactly the unemployment rate. And I heard that stat from Mike Fratantoni and Marina Walsh from the NBA. So, you know, out of all the things we underwrite for, out of all the guidelines, all the things we look for, assets, income, credit, this, that, and the other, like at the end of the day, like if you don't have a job, you can't make the payment. If the unemployment rate's 3.5% or if it's 4.5%, that's typically what the default ratio is. So are we starting to manage to that risk? Are we starting to say there's a soft landing? I'm not saying that Fannie's saying that. But all the financial institutions are realizing it's not as bad as feared. So neither is inflation. And at the end of the day, that's all good news. And so as inflation comes down, as the economy continues to slow, you know, we all have to sit around and wait for the Fed to kind of realize it, because they're the ones, you know, raising or lowering the Fed funds rate, which is the cost of money. Okay, so let's get back to money. We buy and sell money. All right. Today, the CPI number was good, but the 10-year Treasury went up, call it 10 basis points to 4.1. Why is that? August is kind of a low liquidity month. And when there's less liquidity out there, remember, it's stocks and bonds. So bonds is, you know, treasuries. And people invest in bonds and treasuries and notes and bills not to lose money. And the stock market's been pretty exhausted. I mean, there's been a nice run up here the last couple months. And so a lot of money has gone into stocks. And so it's okay for that to take a little breather. And if there's less liquidity going into equities, it's kind of whole asset class is called equities, and more is going into fixed income, bills, notes, and treasuries. The bills and the notes bonds this week the note auctions were good. The 3-year and 10-year were very good, very receptive this week. But the 30-year was less than average, the 30-year bond. So that volatility ends up showing up in our mortgage interest rates. It could be a weekly thing. So will a 10-year go above 4.25 and break that resistance? I don't know. I don't know what's going to get it there. You know, the bond vigilantes can try and require more yield if they so choose and fight back, but they can only do that for so long. The Fed is really the one calling the shots, and so is the broader economy. So I've got some cool stats to go over as it relates to the broader economy. In the CPI, 45% of the CPI basket is in disinflation. It has only been this high amount of all the stats and figures and numbers inside the CPI basket at 45% is in disinflation, straight up going down. That's only happened in recessions. And so that's a big stat. We hear about super core versus core. So there's the CPI inflation, there's core inflation, and then there's super core. So what's super core? I think super core is being looked at because it strips out the housing components, and super core inflation is 4%. Not quite the 2% Fed funds target, but way below the 5.5% Fed funds rate that we see out there. So super core is being looked at more, and it strips out housing. And I think that's a setup for the Fed and the officials to start to admit something I've been saying for years and been fearful of, that home prices are getting out of touch. And if you don't get into a home between now and November, this might be your last good time to get in. There's no middle class in Europe. You either have a house or you're nowhere near getting a house. So my advice is to get a house. I don't see the supply thing correcting itself anytime soon. So super core. And then GDP plus, which is GDP plus gross domestic income. So GDP plus GDI. That number, those numbers combined show the economy's not doing as well as we think. And some say we've been in a recession since late 22 and early 23. I got so much more I want to say, but have a great weekend. Go Leos. End the summer strong. About to get hit by a police officer. Cheers.
You've been listening to KP Talks Dollars and Cents, a top-rated show for those who want to learn about the economy and mortgage environment. Tune in each week for more episodes, and please leave us a 5-star review on Apple Podcasts and Spotify. Kevin Perenio does not render or offer to render personalized investment or tax advice through KP Talks Dollars and Cents. The information provided is for informational purposes only and does not constitute financial, tax, investment, or legal advice. For more info, follow KP Talks Dollars and Cents on all of our social channels.